again, you can see how gold is sort of running out of the system. It's going to lead to a situation where gold's value in its own right, and I'm not talking about measuring it in dollars or euros or anything, gold's value in its own right looks set to rise. And that is going to accelerate the dollar crisis, in my view. As far as the Bank of China is concerned, they're not in there buying gold. They're getting rid of dollars. Yeah. I mean, they know these guys aren't idiots. They can see what's going on. They can see that America is in a debt trap. They can see exactly what's happening. So they just want to basically get rid of dollars.
Good evening and welcome to our Financial Insight segment. Tonight, we delve into the latest developments in the global gold market and what they could mean for the future of international finance. In a significant move, China's banks are raising the stakes as gold prices surge, reflecting a growing demand for the precious metal among retail investors. With 6 major Chinese banks increasing the investment thresholds for gold savings accounts, the message is clear: caution is warranted. And these changes come as the People's Bank of China, after a 2-month hiatus, has granted new gold import quotas to manage the flow of bullion into the country, the world's largest consumer of gold. But what does this mean for the global economy? Renowned economist Alasdair Macleod offers an intriguing analysis. According to Macleod, Chinese gold savings accounts are denominated in gold, not currency, which compels banks to purchase physical gold to back these accounts. The limited capacity to rely on paper gold, such as ETFs and futures contracts, has further fueled the demand for physical gold, tightening supply and potentially driving prices higher. This surge in demand isn't just a local phenomenon. While Western markets have seen some outflows from gold ETFs, China has more than compensated with substantial inflows into its own ETFs during the February-April price rally. If this trend continues, it could lead to even higher gold prices, signaling a significant shift in the market. Macleod also points out a broader strategic move by China. The Chinese government, acutely aware of the U.S.'s mounting debt challenges, is not simply accumulating gold. It is strategically reducing its holdings of U.S. dollars. This move is a calculated response to the global financial landscape, where the value of paper currencies, particularly the U.S. dollar, is increasingly under scrutiny. With $3 trillion in reserve assets, of which only 5% is...
Gold broadly remains the same. It's the value of the paper currency which is declining. And I think that's the important thing.
Yeah.
Having said that, when you get a flood of people going out of the paper currency into gold, then the value of gold in terms of its purchasing power, measured against particularly commodities, for example, that will tend to rise. So pure supply and demand. And I think, this is something which I don't think has been fully appreciated in bullion markets. If you look at China, household savings run at around about 35% of GDP. That's $6 trillion. $6 trillion every year, no longer going into property, not really attracted into the stock market. It's just going into deposits on banks' balance sheets. Now, banks also by law in China have to, or regulation probably rather than law, have to offer gold accounts. This comes back to the whole of the gold thing. The Chinese government are preparing their population for this. And these gold accounts, basically, if you've got 500 yuan, maybe 600 yuan, you can open a gold account. So less than $100 equivalent, you open a gold account, and that account is denominated in gold. It's basically an unallocated account as I see it, but what it does is it leaves the liability with the bank with a gold liability. So what does it do? It has to go out and buy gold in the market in order to have it. The idea that you can back these customer accounts with paper gold, is actually severely limited. And this is what's now happening. This is the drain of gold coming out of our markets is actually increasing. One of the things I monitor is the withdrawals from Comıng. And every day, pretty much, there's significant withdrawals coming out of Comıng. And we're talking about, not small quantities. Over a month, it can be 250 tons, for example. And then there is the other side, which you can't immediately see, the exchange for physical. Now, what an exchange for physical is, it's an exchange of a COMEX contract for a London forward. So why would you exchange a COMEX contract for a London forward? Well, the answer is that you sell your COMEX contract, you buy your London forward position, and then you take delivery. So here again, you can see how gold is sort of running out of the system. It's going to lead to a situation where gold's value in its own right, and I'm not talking about measuring it in dollars or euros or anything, gold's value in its own right looks set to rise. And that is going to accelerate the dollar crisis, in my view. I think I've made this point on your show before, and that is that as far as the Bank of China is concerned, they're not in there buying gold; they're getting rid of dollars. Yeah. I mean, they know these guys aren't idiots. They can see what's going on. They can see that America is in a debt trap. They can see exactly what's happening. So they just want to basically get rid of dollars.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
$1 billion in reserve assets, of which only 5% is in gold, China's actions could have a profound impact on global markets. Now, let's take a step back and consider the historical context. For centuries, international currencies were backed by gold, providing a stable anchor for global trade. However, the US dollar has stood out as the first primary currency to endure for decades without a direct link to gold, a unique phenomenon in financial history. This detachment from gold has made the dollar vulnerable, particularly in times of high inflation, when investors typically flock to gold as a hedge against currency devaluation. The surge in gold prices in April 2011, when it reached an unprecedented $1,500 per ounce, is a prime example of this phenomenon. Fears of declining fiat currency values drove investors to seek refuge in gold, reflecting a widespread lack of confidence in global currencies and a bleak outlook for
rise and decline of empires rather than currency. Because until Bretton Woods, basically currencies, international currencies were backed by gold to a greater or lesser degree. So really, this is, with the Americans' dollar, this is the first time you've had a currency lasting for decades without any anchor in terms of value on an internet basis. Okay, so this is very, very different. I think that from China's point of view, it makes no sense at all to take on that mantle. In other words, the next fiat currency, if you like, which the world uses. I mean, I don't know what their thinking is, but I would, if I was asked by the Chinese what my view is, I would say, put it on a proper gold standard. Then it really doesn't matter, because the future of your currency in terms of how it's used and all the rest of it will come and go with your influence around the world, not with the management of your currency, which is really where America has gone horribly wrong. And this is why I think China has accumulated a lot more gold in secret than publicly declared as reserves on the People's Bank's balance sheet. They've been doing this since 1983, when legislation was put in place for the People's Bank of China to operate in markets, acquiring gold and silver on behalf of the nation, the state, the Communist Party, whatever. And ever since then, they stepped up their mining output and rapidly became the world's number one gold miner by output. Stepped up the refining, which they kept very much under state control, and banned effectively any exports of gold. So it's all been accumulating. I mean, I say it's sort of China's Hotel California for gold. You go in, but you can't get out. The faith and credit in the US dollar in the euro. I mean, the euro could put itself on a gold standard because some of the major countries actually do have substantial reserves. But they wouldn't be able to do the other thing, and that is contain the spending, because you can't go on a gold standard without containing government spending. I mean, where the Americans went wrong, if you like, leading up to the collapse of the Bretton Woods system, was, that gold sort of meant that prices did not rise that much in the post-war years. But the expense of that in terms of growth of GDP, because the growth in GDP, it multiplied something like 6 times over that period. The growth in GDP basically meant that the other side of the price stability was the gold reserves were running out. You can't inflate your credit without an effect on prices. Now, if the prices are anchored to gold, then what happens is the gold disappears. It's actually as simple as that. And that's basically what America did. So you must contain spending. And the other thing you must do is to encourage saving, which means changing your tax policy
in global currencies and a bleak outlook for economic stability. Looking ahead, Macleod suggests that the euro could potentially return to a gold standard, but this would require strict control over government spending, a lesson the US learned the hard way during the Bretton Woods era. The end of the gold standard in 1971 marked the beginning of the fiat money era, fundamentally changing the landscape of international finance. As we witness these developments, one thing becomes clear. The rise and decline of empires are intricately linked to their monetary policies. Could a return to a gold-backed system offer the stability that modern economies increasingly seek?